All right, let's talk about taxes. I know, it's not always the most thrilling topic. But what if we could flip the script? What if we could turn that yearly chore into a smart financial strategy? That's exactly what we're going to do. It's all about understanding the rules of the game so you can start winning. So let me ask you this, and be honest. Are you leaving money on the table when you file your taxes? Because so many people are, simply because they miss out on things. Today, we're going to dive into how you can legally and very effectively lower your tax bill and keep more of your hard-earned money right where it belongs, with you. So here's our game plan. We'll start with the absolute basics. Then, we'll get into the big one, deductions versus credits. From there, we'll talk about how to supercharge your savings, cover some next-level strategies, and wrap it all up with a concrete action plan for you. Okay, first things first. You can't really strategize if you don't speak the language, right? And the language of taxes starts with a few key forms. Understanding these is the first step to lowering what's called your taxable income, which is just the slice of your earnings the government actually gets to tax. Think of these forms as the individual pieces of a puzzle. Your employer sends you a W-2 that shows your wages. Your bank might send a 1099 INT for the interest you earned. If you're a freelancer, you're getting 1099s. Each one is a little snapshot of your income that gets reported to you and, of course, to the IRS. And where do all those puzzle pieces fit together? Right here, on the Form 1040. This is the big one. It's the master document where you assemble your entire financial story for the year. This form is what ultimately tells you if you owe more tax or if you're getting a refund. Okay, now we get to the fun part. Let's talk about the two most important tools you have for cutting your tax bill. Seriously, understanding the difference between a deduction and a credit is maybe the most important concept in personal finance. And here it is, the million-dollar difference. A deduction is good. It reduces the amount of income you pay tax on. But a credit? A credit is amazing. It's a dollar-for-dollar reduction of the actual tax you owe. Think about it. A $1,000 credit saves you $1,000, period. A $1,000 deduction only saves you a percentage of that, whatever your tax bracket is. Credits are king. Now, most people just take the standard deduction because it's easy, but you have to do the math for yourself. If your specific expenses, like state taxes, mortgage interest, or big charitable gifts, add up to more than the standard deduction, you should itemize. If the standard amount is, say, around $14,000, but you paid $10,000 in state taxes and $5,000 in mortgage interest, well, that's $15,000. Itemizing is a total no-brainer. All right, let's shift gears. We're moving from just filing your taxes to actively using the tax code to your advantage. And a huge part of that is using specific accounts that are designed to save you money on taxes right now. This is, hands down, one of the most powerful and accessible strategies out there. When you put money into a traditional 401k or an IRA, that money comes right off the top of your income before taxes are calculated. It's a beautiful win-win. You're building your retirement nest egg and you're cutting your tax bill today. Let's make this super simple. Say you earn $70,000. If you put $6,000 into a traditional IRA, the government now only sees you as having earned $64,000. Poof! You just shielded $6,000 from taxes for the year. It's that direct. Okay, now if you have a high-deductible health plan, you need to listen up, because the Health Savings Account, or HSA, might just be the single greatest savings tool in the entire tax code. I'm serious. It's the only account with this triple tax advantage. You get a tax break when the money goes in, it grows completely tax-free, and it comes out tax-free for medical costs. It is a true financial superpower. Ready to level up a bit? For those of you with investments or saving for college, there's some even more sophisticated strategies we can use to really get ahead. This one sounds a little complex, but the idea is actually pretty simple. Let's say you have one investment that did great and another that, well, didn't. You can sell the loser, harvest that loss, and use it to cancel out the taxable gains from your winner. It's an incredible way to turn a down market into a tax-saving win. And it gets even better. If your losses for the year are bigger than your gains, you can use up to $3,000 of that excess loss to lower your regular income, like from your job. Any losses you have left over, you can just carry those forward to use in future years. It's the gift that keeps on giving. But there's a catch, and you absolutely have to know this one. The IRS has something called the wash sale rule to stop people from gaming the system. You can't just sell a stock to book the loss and then immediately buy it right back. You have to wait for a 30-day window to pass, or else the IRS will say, nope, you're not eligible. It's a 30-day window. If you wait past that, the IRS will say, nope, that loss doesn't count. Now, for anyone out there saving for college, 529 plans are just fantastic. The money grows tax-free, and you can pull it out tax-free for all sorts of education costs. But here's the real kicker. A lot of states will also give you a state tax deduction just for putting money in. That's a powerful double dip of tax savings. Okay, we have covered a ton of ground, but all this knowledge doesn't mean a thing without action. So how do we actually put this into practice? Well, it starts by changing your mindset from a last-minute scramble in April to a smart, year-round routine. The big takeaway here is so simple. Do not wait until next spring. Start now. Go create a Taxes 2024 folder on your computer right after this. Start tracking your charitable gifts in a simple spreadsheet. Make these little habits part of your routine, and I promise tax time will feel like a breeze instead of a hurricane. And look, doing it yourself is great, but it's not always the best move. If you have a major life event, you get married, start a business, sell some property, hiring a pro is a smart investment. A good tax advisor can save you way more than they cost by spotting opportunities you'd miss and keeping you out of trouble. So, as we wrap up, I want you to think about this. What is the one thing you learned today that you can actually start doing this year? Are you going to max out that IRA, look into an HSA, or maybe just get organized? Because the moment you shift from just filing to actively planning, you take control. And that, right there, is how you build a stronger financial future.